We're tracking developing news around the attempted assassination of former President Donald Trump. Taking a look at the U.S. markets this morning, stocks trading higher to start the week. We have a slew of corporate earnings on deck. Some of those has come out this morning, but of course, all eyes continuing to be focused on that assassination attempt on former President Donald Trump over the weekend at a campaign rally in Pennsylvania. You're taking a look at some of the video from that event as it was playing out. Investors are digesting what impact, if any, the attack is having or will have on markets and the election. Now, we've seen moves higher in assets of the so-called Trump trade. Bitcoin rising over the last 2 days, and also shares of DJT are surging here this morning. Earlier this morning, I spoke with Terry Haynes, who is the Pangea Policy founder, about whether or not the rally there would last. Here's what he had to say.
I think there's a great deal of sentiment involved in this, and most likely egged on by betting and prediction markets. And that's fine. I mean, markets trade on sentiment all the time, and those sorts of things. But in terms of long-lasting impact, or long-lasting in markets these days is maybe this week, but long-lasting, I'd really watch out for it, because prediction markets don't bear any resemblance to what's actually going on the ground. The political side of this is pointing at the prediction side as saying this isn't going to last.
Yahoo Finance also spoke to Tom McLaughlin, who is the co-lead for Election Watch at UBS Global Wealth Management. Tom acknowledged the market boost today could be due to second quarter earnings, but also said it could be a sense of relief that the weekend's event weren't worse.
It also could be a little bit of a relief in the sense that it could have been worse. I mean, we actually, sympathy goes out to the families of those who've been critically injured and the individual who passed away. But there's a relief in the sense that what is certainly a bit of a tragedy could have been much worse had the president actually been killed, the former president. So we're looking at a situation where hopefully we get back to a little bit more normal.
Sticking with the 2024 election and the possible impact to markets, we have Matt Miskin, who is the Hancock Investment Management Co-chief investment strategist. Matt, great to grab some time with you here this morning. I would love to start with just knowing how you're looking at the events from the weekend and in the context of the market.
So we're going into today seeing small caps continue their epic rally. And really, they started rallying on the inflation report, which was going to be a lower interest rate regime. So the thought was inflation comes down, rates come down, that helps smaller cap companies that have greater leverage, lower interest rates, good. Today, we're coming in with a bear steepener. Rates are up and small caps are still ripping. So we've gone from last week being a lower rate, lower inflation regime to the Trump trade, which is small caps and a bear steepener. And that's breaking a key dynamic that had been really embedded in this market. Small caps and treasuries were as correlated as they've ever been in history running up to this. And so we are starting to get political input into markets. We do not see this as sustainable. We do not invest based on politics because it is incredibly unpredictable. And even if you had gotten Trump last time he was president right, the winners of the overall 4 years of his administration were large cap growth, tech, and Chinese stocks, not small caps. And so when you look at history here, it doesn't suggest that this kind of rotation may not get further legs. So we just want to be understanding that it's a trade likely. But overall, the fundamentals we think favor more larger cap, higher quality type businesses.
You know, it's interesting, and you started to mention this, the elements perhaps of the Trump trade as you're tracking them. What is the composition of that?
Yeah, it all comes back down to greater deficit spending. And this isn't, whether it's Republican or Democrat, really in the last 8 years, regardless, it's been increasing deficit spending. So that in theory increases Treasury supply, increases Treasury yield. So you've seen the long end of the Treasury yield curve increase. That yield's gone up to 30 years, actually uninverting from the 2-year for the first time in a long time. So that, though, then usually had meant weakness on small caps, weakness on financials. And now the thought is, well, less regulation on small caps and financials. That actually helps those parts of the market. So it's a big change, actually, underneath the hood of the market here as politics move to more of the front and center as a market driver.
Let's turn to some broader themes that you're looking at this week as well. Inflation, corporate earnings. As I've been continuing to track some of the data that comes out from FactSet on a weekly basis, just thinking about at this very early stage they are of the second quarter earnings season for the S&P 500, it is off to somewhat of a mixed start. And we got, of course, BlackRock, Goldman Sachs here to begin the week. What is the theme that you're expecting to play out over the course of this earnings season?
Yeah, Brad, it's still about winners and losers right now. And as you pointed out, some of these companies that are reported first are higher quality businesses that are taking market share. And they've actually been doing well. And the stock price is already up a lot going into earnings. So, to us, it's going to be a bit of show me something good here. Because it's already in your price. And that's another thing. Broadly, you're talking about seeing this economic data. Last week was soft landing island, grab a drink and chill out market environment. So you had initial jobless claims fall and inflation fall. So you had better economic data, decelerating inflation. That is the best case scenario. And what we're also seeing is, even though there's all this political uncertainty, there's another Fed rate cut now priced into the back half of this year. So the thought is the Fed's going to cut rates 3 times now in the back half of this year. That's actually providing a nice buffer for volatility and likely helping equities as well into this week.
When you talk about winners and losers, are there certain sectors that you expect to continue either outperforming or to finally catch up to the broader trade over the course of this earnings season?
Yeah, we do see parts of the market seeing some catch up. We do like mid-cap industrials. They've seen great fiscal policy support in terms of building out the manufacturing renaissance across the U.S. They're more U.S. focused, which is actually helping their businesses. But in terms of the high quality tech side, for us, it is likely to deliver good results, but it's in the price. And that's also tough because fundamentally you're saying, hey, this is a great business, but look, it's up a lot. It might actually see some selling pressure if there's any whiff of a miss, whether it's forward guidance, whether it's revenue, or even the bottom line.
Matt, great to speak with you. Great to see you. Thanks so much for taking the time here with us on Yahoo Finance. Hancock Investment Management Co-chief investment strategist, Matt Miskin.